Hello everyone, and welcome to this webinar in our Ideas for Your ISA series. Shortly we'll be hearing from Olivia Markham, one of the managers of BlackRock World Mining, after an excellent year for the trust. In fact, BlackRock World Mining just published results for 2025, in which it posted the largest ever gain in asset terms in its history. I'm sure Olivia will be talking through the factors that have led to that excellent performance. There's been a bit of volatility in recent weeks for obvious reasons, and the shares have moved out to a slight discount of 5% at the time that we're speaking, which could be an additional interesting factor, particularly given it looks like we might be getting a ceasefire in the Middle East. So I'm going to hand over to Olivia, and a reminder that we've got about 25 to 30 minutes reserved for the presentation, and then plenty of time for questions at the end. Please do put your questions in the box on the right of the screen. So Olivia, over to you.
Brilliant, thank you, Thomas, and thank you everyone for joining here today. It's quite a pleasure to be able to present the results from last year, given such a strong performance from the World Mining Trust. So if we kind of go through this relatively quickly, we've got quite a few slides, but I'll keep it at a reasonable fast pace. If we just move to the next slide, thanks. Go through, fantastic. So if you just go through some of the highlights from last year, as you can see, some really strong kind of asset growth, up 74% in both the share price and the NAV during the course of last year. Strong dividend, actually an improvement on our dividend from the prior year of 24p, resulting in a yield of 3%, and kind of the net assets kind of topping around £1.6 billion for the year as well. If we just move on. I won't spend too much time deliberating on this, but you can just see a bit more of a track record in terms of performance. I think what's quite interesting to see here is, this really has carried through into this year. This is data through to the end of February, so it doesn't capture the war in Iran, but you can really clearly see that the momentum that was, being generated by the sector, the move up in commodity prices has continued in 2026, and we'll kind of talk through kind of a lot of the fundamental building blocks and what's driving that. Going through. Yep, snapshot of kind of the discount and actually premium to NAV of the trust over the last sort of 13 years or so. A little bit of a volatile period during 2026 for us. We'll spend some time talking through the sale of our royalty. It meant that we kind of were out of the market, and the directors were now to sort of buy back any shares during that period. But you can clearly see that the discount has kind of structurally narrowed in from kind of the discount levels that we've seen historically, and I think that's got a lot to do with kind of the attractive yield that we deliver on the trust. Next slide. A little bit more just in terms of the evolution and the dividend track record. You can see that there, we fundamentally pay out all of the revenue that we generate. But I think what's important to look at here as well is just the cumulative impact of dividends over time, kind of reaching now £4 per share. It wasn't too long ago that the trust was actually trading at £4 a share. So this is something that we're certainly very proud of, and we just continue to look for interesting opportunities to deliver an attractive yield for our shareholders. Next slide. Snapshot of the portfolio. So this is actually taken as at the end of January, when we last kind of released the portfolio exposure to the stock exchange. A couple of things to note here. Firstly, you can see that growth in NAV, approaching £2 billion. The other thing which is quite clear that you can see by looking at the breakdown by commodity, strong still exposure to gold in the portfolio. That was a really strong source of performance for us during 2025. We'll spend some more time talking about this. Obviously, we have had a move down in the commodity prices, but we continue to see very attractive valuations across the equities. Another key commodity exposure for us is copper. We also have quite a bit of copper exposure within our diversified exposure. Interesting dynamics both on the supply and the demand side. You're seeing quite a lot of M&A come into this market, and we're continuing to look for attractive opportunities, particularly amongst some of the mid-cap producers. We've kind of evolved some of our diversified exposure. You'll see that we've kind of lightened the load on some of our iron ore heavily exposed companies. You won't notice that BHP, the world's largest mining company, is no longer in our top 10 holdings. You can see that kind of just for reference of how we've taken down that iron ore exposure. To be honest, it's been absolutely the right thing to do during 2025. There were just much more interesting growth opportunities amongst some of the base metal names and the precious metals names. So it's really more been a funding source for us. And then we've also got some interesting allocations to some of the smaller, more niche commodities like rare earths, uranium, the platinum group metals we've built up as well, aluminium, which is really benefiting in this market with the tightness in energy markets that we've seen. So we'll just move on to the next slides. So the next couple of slides are going to go through to some of the outlook, and I'll try and keep this relatively quick. Just a snapshot on performance of the sector. We have started to see the mining sector outperform a little over the last 5 and over the last 1 year. You can really see that a lot of that has been driven by gold, which is that yellow line for you. But as we've moved into the back end of last year and into this year, it's starting to broaden into some of the industrial metals as well. And we think that we are seeing the signs that we are moving into a more capital heavy phase in broader global markets. The commodity intensity of GDP is increasing, and that's starting to flow through and trickle down into stronger demand for a lot of the mine commodities. On to the next slide. Now, one thing we've been talking a lot to shareholders and investors more broadly over the last sort of 6 to 12 months is, when you start to look at the breakdown of global GDP and you look at areas of the market that are attracting a lot of attention, everything from AI, powering AI, physical building of data centers, step up in defense spending, step up in energy independent spending, all of those end markets have a very heavy dependence on metals. And you can see here, if you look at global GDP, around about 40% of global GDP is heavily reliant on metals and materials. However, if you kind of look at, the weighting that the mining sector has in broader financial markets, it's largely irrelevant. It's 2% of MSCI equity, as we sort of show you here in this pie chart. So we think there is a disconnect here. I think there's something that, governments are thinking about, as they're looking at their plans and where they're allocating capital and their key objectives, they're wanting to fund and provide funding for, metals, mining companies, because they do see it as a key bottleneck. I think as investors, we should probably be questioning, is it right that that these sectors, are so, have such a small weighting in overall markets relative to, the importance to so many end sectors. And I think people are beginning to understand this, and it's sort of in part why we're starting to see this, the beginning of a rotation into the more capital heavy real asset areas of the market again, which is clearly the kind of the trade that took off on the back end of last year. Next slide. A little bit more, just sort of framing this for you. You can see here other key areas of commodity demand growth is areas around infrastructure. The forecast suggests that we're going to spend substantially more on infrastructure in the next 15 years than what we did in the prior 15 years. We continue to have a growing global population, and within that population, more and more people are moving into the sort of the wealth bracket as shown here in yellow, where they start to increase their commodity related spending on everything from cars to air conditioners, to powering their homes, etc. So we've got quite a nice undertone here of quite fundamental building blocks for commodity demand. And then if you go on to the next slide, areas that we are, particularly interested in, and I think this is a really good kind of series of slides just to frame the scale here, is the investment that we are seeing into AI. Clearly, this has been driving broader markets over the last 12 to 24 months. And if you have a look at this chart on the right-hand side, which shows you the capex spends by the hyperscalers, they're spending substantially more capital than what they have in the past. Roughly 1/3 of their capital spending relates to the physical build of the data center and powering that data center. That's where the materials aspect comes into it. And if you compare that number to what the mining sector itself is spending on capex, we've clearly got a gap. And so we believe that as we see more and more spending occur I guess, further downstream, that's obviously going to have to flow back into greater demand pool and greater, demand requirements from the mining sector to deliver into. On to the next slide. Now, another key focus, for the mine commodities, particularly those critical minerals, is the effective weaponization that we saw across a number of commodities in trade negotiations last year. There's been a lot of focus and a lot has been written around rare earths, where China has an absolutely dominant position in both the mining, the processing, and then the conversion into magnets, which is what you actually use rare earths for. And they have used that as a weapon and a trade tool in negotiations with the US government and with other governments around the world. Whilst people think this is largely just an issue for rare earths, it's actually much broader than this. China, if you have a look at this chart on the bottom left-hand corner, you can see that China has a dominant position in many commodities, everything from the processing of steel, copper, cobalt, some of the platinum group metals, lithium. So all really, really key important commodities when we look at kind of areas focused around growth in the future. And governments are looking to try and counteract this. We're seeing a lot of money being allocated to building up critical minerals funds, trying to support more critical minerals investments domestically. But the reality is that this is going to take time. It's going to have an inflationary impact on the commodities. It's going to continue to push commodity prices higher. And we think that's a pretty healthy position to be in, provided you can be invested in those companies that can be at the bottom of the cost curve and actually benefit from that price rise and can potentially unlock projects in their own portfolio through cheap government funding. And we've got a number of examples of that occurred during the last 12 months. On to the next slide. Now, we've talked a bit about here on demand. So, everything from electrification, increased infrastructure spending, powering AI, all kind of quite long-term demand drivers. I think from our perspective, and something that we have talked about for a number of years, is really just the challenges that we see on the supply side of the equation, the challenges to be able to deliver the kind of the forecasted demand that we see. And it's really around the underinvestment into new supply that has been occurring for the best part of almost a decade. So if you have a look at the chart here on the left, we're just showing you here total global mining capital expenditure. This is like a 20-year picture. And if you adjust that for inflation, so you look at that line in red, you can see that we are well below levels that we've seen in the past. We actually, when you inflation adjust it, we're actually not that much higher off some of the low points that we saw back in 2016. Then if you start to look at what capital is actually being spent, you can see the majority of it's just being spent on sustaining capital, the capital you need to spend to keep production flat. And actually the amount that's truly being spent on growth is quite modest. And so when we look at this picture, we're starting now to see a pickup in spend because we've seen commodity prices move up to more attractive levels to incentivize projects to come in. But we do think for a number of the commodities, particularly commodities like copper, we're going to see ourselves in a tight market for a number of years, and that's continued to have this kind of underlying pressure to keep moving commodity prices up higher. So you keep incentivizing those slightly lower grade, higher cost assets to come into the market. If we go on to the next slide. Just a couple of points now on gold. I mean, we've showed sort of at the beginning the commodity breakdown, and we have a bit of under 40% of the portfolio in gold equities. And gold has obviously been an amazing place to have exposure to over the last really 18 months. In the trust, we really stepped up our gold exposure in the portfolio in sort of Q3 of 2024. We had begun to see the gold price move up. The companies started to look very attractive when we were looking at the free cash flow generation of the businesses, and they were trading at sort of double-digit free cash flow yield. But importantly, we'd seen a period of time where the gold companies were starting to be more disciplined, and they were doing a better job of actually converting higher gold prices into higher cash flow, higher dividends, improving balance sheets, etc. And that really continued on as we stepped through 2025. And as we're showing kind of the next couple of slides, we've seen a big move up in margins. The gold equities are generating very, very healthy margins, but actually continue to trade quite cheaply if you look at current gold prices. And I'm also continuing to say that despite the fall that we've had in the gold price, we've actually seen the equities get even cheaper. So in terms of what's really driven the gold price rally over the last 12 months, I mean, there's a number of factors, but I think a lot of it has come down to the recognition that governments have a clear challenge around debt. And if you have a look at this chart here in the top left-hand corner, which looks at a number of governments around the world and nations around the world, you see an ever worsening fiscal situation. As you look forward, we just continue to see government balance sheets expand. It's everything just from the claims around healthcare spending, defense spending, infrastructure spending, some countries looking at reducing their revenue line through tax costs. And at the end of the day, the strength of a currency is really linked very heavily to the strength of the government's balance sheet. And so as people have not wanted to have exposure to traditional fiat currencies, they've looked for alternatives, and that's been gold. So I think that currency aversion trade has been really, really prominent in driving the gold price over the last 12 months. If you have a look just through a couple of other these charts, we've started to see gold ETF buying come back in. We're kind of back up to previous peaks that we saw in 2022, but actually really quite modest in my mind versus how far the gold price has moved up. Central banks continue to be very strong buyer. We're actually seeing new buyers come in for physical gold. Tether, which I'm sure many people are familiar with what they've done in terms of the treasury market, the stablecoin issuer. They've actually become the second largest buyer of gold behind Poland during 2025. And so we just see a number of, we haven't really seen any change in any of this behavior. And I think as we continue to look at that chart on the top left-hand corner, which just shows you that ever challenging pressure that global governments face around their worsening fiscal position, is going to continue to put downward pressure on their currency. It's going to make it very challenging over time to raise rates substantially, and that creates a fantastic environment for commodities more broadly, but in particular the precious metals. And then finally, just another chart on gold. I think we have it here. Go to the next slide, thanks. Oh, okay. Oh, we didn't. But the slide I would like to show, I'm sure we write a lot about this already. It's all in the annual report. Is really just that pickup that you've seen in the free cash flow margins of the gold producers, and that step up in margins has been really important in terms of the gold companies delivering that positive beta to the gold price over the course of 2025. So then just before we kind of finish off and kind of start to open up to questions, I just want to spend a little bit of time talking about the unquoted portion of the portfolio. And we've had a great result during 2025 selling the BHP Brazil royalty, substantial uplift for the company in selling that. And then we've also got a series of other unquoteds in the portfolio as well. So if you just move to the next slide. So firstly, yes, the sale of the BHP Brazil royalty. So just to remind people, back in 2014, we basically did a financing transaction, a royalty transaction, whereby we gave a junior copper producer, well, actually it wasn't even a producer, it was an exploration company at the time, $12 million, where in return for that, we would receive 2% of the copper revenue and 25% of the gold revenue of any mine that was ever produced on kind of their land package area at the time. This asset then went into production in sort of 2016, and we have received, up until the end of last year, a bit over $40 million in royalty income relative to that $12 million investment that we made. And then we were able to successfully sell this royalty for $70 million. So effectively, we turned a $12 million investment into sort of over $110 million in proceeds. That was sort of like a almost 850% return over that time period. And then just for context, the market returned 200% over that time period. So a really, really good source of both income and capital growth from the royalty, and really delighted to kind of be able to deliver that. It was quite a lot of hard work at the end negotiating that, but a really fantastic result. So today, our remaining royalty investment, if we just go on to the next slide, is our investment in the Vale debentures. This is effectively an iron ore royalty. It's actually listed, but it's really quite illiquid. It's very high yielding. It's actually almost a 10% yield, which is very, very high for a royalty investment. And we continue to hold this. These assets have 40, 50-year mine lives. We're going to continue to receive payments from this for a very, very long time. So still very happy to hold that. But we are looking for more royalty investments. Typically, the time to do royalty investments is the bottom of the cycle. But we've got a couple of early stage stuff that we are looking at. So we're hopeful that we're able to kind of replenish the royalty portfolio sometime during the course of this year. We're very selective in what we look at. We have really quite high cost of capital and return thresholds. So we don't necessarily compete in the way that the precious metal royalties companies compete, but I think selectively doing this and being patient around our holding timeframes is showing that we can deliver some really, really strong results. And then just finally, just two of our other unquoted that we should just touch on. Our first one is our sort of copper technology company called Jetty Resources. This has been kind of not, probably as successful as we wanted it to be. They did a very strong funding round back in 2023. They raised some capital at a very high valuation. We've actually taken the valuation back down to where we initially, or close to where we initially invested. And we're still kind of looking to see the progress that Jetty is making at applying their leaching technology, their leaching catalyst at Escondida, the world's largest copper mine, which hopefully that does prove to be successful for them, and I think it will kind of just unlock quite a lot of potential for the business. And then finally, just our last unquoted before I start to open up some Q&A is sort of a early stage copper exploration company in Colombia called MCC Mining. This has been also a great success for us. So the initial investment was around about I think it was like 20 basis points of the fund. They've done a couple of funding rounds to keep funding their exploration. They've had great success. You can see that they've done these at higher funding rounds as the position in the portfolio has grown quite substantially. And this is elephant country. They've had some drill results and kind of resource growth that suggests these could be tier 1 assets, but it will take time to play out. And we've got to sort of see how the elections play out and where broader markets are at, but potentially this could be looking at becoming a public company over the next couple of years. If we just kind of move over to another slide, I'll kind of just can go back to maybe Harris, so we just take it back to the snapshot at the beginning. But I think, look, overall, obviously 2025 was a fantastic year for the company, fantastic year for the sector. We're very happy that we were able to not only deliver strong performance, but also deliver some really strong outperformance with areas like the sale of the royalty. We've had some smaller investments that have delivered really outsized returns as well. And clearly, as we sit here today, it's a volatile market. We've seen quite a sharp pullback across the commodity complex. We've seen a sharp pullback in the mining equities, the World Mining Trust share prices, as an example. But as we have seen in the past, you often can have these risk-off events can often present great opportunities, and we are, being very careful, kind of looking through and just seeing where areas that we're going to selectively look back to when we think we start to see kind of resolution occur in the Middle East. So with that, I'll happy to pause and take some questions.
Brilliant. Thanks very much, Olivia. We already have quite a few questions, but if you're in the audience, please do keep them coming, as we have plenty of time. Maybe we could start there with the situation in the Middle East. So we had a couple of questions about that. Firstly, does BlackRock World Mining have any assets in the region? And secondly, have you repositioned at all in the light of the outbreak of the hostilities?
So in answer to the first question, no, we don't really have any exposure in that area. Some of the companies have one company, it's an aluminium producer, they have a joint venture with one company in there, which is in Qatar, but relatively modest impact to the business, and actually what it's done to the aluminium price has been far more positive for them. So we're kind of insulated from that, but obviously we're not insulated from the fact that the commodity prices have moved down. In this environment, I think we have seen there hasn't been a lot of I'm going to use the word sort of discretion in the way people have traded this. It's just sort of been a liquidation. And so there's been pockets of the market that have done quite well. So we've got some companies that have got some coal exposure, aluminium exposure has done relatively well. Really we've wanted not to do anything terribly drastic during this period of time. We just wanted to ensure that we don't have excessive gearing, given just the volatility that's going on and the natural high cyclicality of the sector. So we haven't looked to sort of, I guess, try and lock in too many undue kind of overdone share price moves. Probably the best way I describe it.
And specifically, what about the gold miners? Because they've obviously had quite a bit of a big sell-off after doing so particularly well. What would lead you to start adding a bit back there?
So I think the first thing that, and look, this is not the first time we've been through these events, right? We saw something akin to this in sort of Russia, Ukraine. I'd say Liberation Day, we saw a huge amount of volatility. Similarly, COVID, we saw a huge amount of volatility. So I think some of the lessons that we've learned is you don't necessarily have to get pick the exact bottom, and it's very hard to do that. I think for what we're doing is we've always got our list of companies that we would always like to be able to add more to, because we fundamentally believe in the long-term stories for these companies. There's been some examples where we've just seen outsized share price moves on those, so we've been selectively adding back. If we look at the gold companies, we've seen, yes, obviously the gold price has moved down, but actually the gold equities have, we would say, got cheaper against that. They've moved in excess of what kind of we would expect the normal beta relationship to be to the gold price. And I think you also need to remember that these companies have got incredible financial strength. We're not seeing any concerns around balance sheets or anything like that, because these companies have all got kind of rock solid financial positions. So for us, I think what we've probably has been driving a lot of this, we did see quite a lot of retail participation in gold, in the gold ETF, and I think we're just seeing areas that money have flown into, areas have seen money flow out of it relatively quickly, and that's what's having this sort of outsized impact. So we're selectively looking. I think we are definitely seeing value, very strong valuation support. I think before we want to do anything quite substantial, and really take up gearing or write a whole lot of push options or those sort of things, is you probably just want to get a little bit of stability, and actually just because otherwise I think you can run the risk of just trading on news flow versus on kind of fundamentals.
Great, thank you. We had a question about uranium. So you've got about 1.1%, I think, according to the chart that you showed. What does that tell us about your view on uranium? Is that a negative view that it's so small?
So I would just say that uranium is a small area of the market. There's not a massive investable universe that we can invest in relative to the gold universe or the diversified miners. So we've actually had a long-standing position. Our uranium exposure is with Cameco. We've had a long-standing position in Cameco. We've kind of taken it up. We substantially increased our exposure when they did a transaction to buy Westinghouse, which makes them vertically integrated from producing uranium to all the way down to building reactors, servicing reactors, and producing a nuclear fuel. So we've actually we've traded that position around, but it's I would say that our uranium exposure could never be that big because it's only so much of the universe for us to invest in, and we've over the years we've had some junior uranium producers in the portfolio. We've just kind of certainly over the last sort of 12-24 months we've been hard pressed to see a company that we believe can perform better than Cameco because of that full kind of nuclear supply chain integration they have from mine to reactor, and it's really led them to kind of grow their market share.
A question about the royalty, which obviously was a fantastic investment. But the question says, so what downside protection is in place for these unquoted investments?
So the downside, I mean, so when we think, I guess with that question is referring to valuation. There is in certain financing rounds, you can have protections built in. We don't currently, but we can have protections built in and being able to, if there's a down financing round, to have your position increase so that you're protected in that sort of scenario. I think for us it's the same way that we look at any investment. We make sure that we appropriately size and scale these unquoted investments based on where the companies are in terms of their life cycle, because we're often investing in earlier stage projects. So if you take the example of MCC Mining, this initially was a high risk investment for us, a relatively early stage company, relatively high risk, but it was initially about a 30 basis point position. So I don't think we're not betting the farm on some of these, but we do. The reason we make the investment is because we can see so much right tail optionality that we think it's worth it. So I think that the protection that we have is really just around the work that we do. We have a bespoke department within BlackRock that we have to take all of these investments to initially and have them pass our kind of private investment review committee, doing a whole lot of sort of background checks on individuals, etc., just to make sure that the due diligence is appropriate. And I guess the other kind of somewhat protection as to a shareholder is we do have sort of requirements around the overall exposure of the portfolio that can be we can't have more than 20% of the portfolio to unquoted. We've never got anywhere near that, but typically on initial investment it would be no bigger than 300 basis points of the gross assets of the fund. So I think it's more at the portfolio level versus we having the protections that you may see like with private equity outfits, because that's not the way the fund has been structured.
Great. On the dividend, so obviously BlackRock World Mining has paid a pretty high income over the years, but the dividend does tend to vary. Are there any thoughts about moving to a more consistent dividend payout policy rather than paying out varying amounts?
Yeah, I mean, maybe we can just go to that dividend chart over time, but look, for us, we pay out what we generate. If you have a look at the sector, and as we had a period of time during this is sort of post-COVID, so the cash flows from 2020, 21, and a bit in 22, where we just had record high iron ore and coal prices, and that really led to these almost sort of supernormal dividends that came out from the companies. What we've seen in terms of the companies that we own in the portfolio, they've largely moved to payout ratio, so their own dividends are moving around with effectively earnings, which is a lot of that is driven by commodity prices. So we're just aligning ourselves to that. I think if we try and have a mechanism to manage the dividend over time, I think we'll run into potentially run into a challenge where you start to fund that dividend from capital, which obviously people can choose to do that, But I think we just want to kind of align ourselves naturally to what the underlying holdings of the companies are doing, and we felt that's a better way to do it. The one thing I would add, though, is that because we are able to generate income from other means than just the dividends from the underlying holdings, we've been able to deliver a more consistent dividend than what you would get, out there from just owning single equities. And that's something that we like to pride ourselves. So hopefully we can have a more defensive or diversified income stream, and hopefully we can also enhance it relative to what's out there for people who might own single names in the mining space for their mining portfolio.
A couple of questions here about the UK energy situation. Do you think that the UK should be drilling in the North Sea? Do you think the UK should be fracking?
So I think the economics of drilling in the North Sea when there's a 78% tax rate is very challenging. So I think that's probably more a point around policy than it is around whether companies should be going there or not. But clearly, if you have a look at the stats in the UK, we're not competitive on labour and we're not competitive on energy costs, and that is a challenge that the economy faces. I don't know if we have the ability to have a sizable fracking industry. I don't know if we don't see ourselves sort of competing against the US, but I do think we need to think about how we can, create a more resilient, independent energy supply source for the UK that's also competitive. I think quite a lot of work needs to go on that. I mean, we've had huge challenges around this over the last couple of years. But I would say, though, importantly for us in the World Mining Trust, we may have companies listed in the UK, but we don't really have any assets that are located in the UK in terms of our investments.
Great. Got just a couple more questions in the hopper from the audience. So maybe make this a last call for questions. There's been a lot of issues in the sector around Saba. So could you tell us, does BlackRock currently have an agreement with Saba about BlackRock World Mining?
So there is for the World Mining Trust, we have a kind of almost like a standstill agreement with Saba for the last couple of I think it was when we signed it. It was sort of for a 2-year period. We've actually we haven't had any challenges around this at all. I think we're an investment trust of size, scale, strong performance track record, and unique in what it does. So we've really not been particularly I guess concerned about Saba. All the feedback that we get from our shareholders, they're very happy with the job that we're doing. I think we've done a pretty good job in terms of managing that discount. The discount did widen a little bit at the back end of the year, and that's really because there was some, for us, that we having in the process of selling the royalty, there were long periods of times where the board was blacked out from being able to be more opportunistic in the market around buybacks. But I think from our perspective, the main thing is we're doing what the shareholders want us to do. The feedback is generally positive, and as a result, we haven't had sort of pressure from groups like Saba.
Yeah, we have one comment in support of paying the dividend from income received rather than from capital. There was one question about tungsten. Do you have any view on tungsten, and do you have any exposure?
So tungsten, it's an amazing. I mean, the tungsten price has been five, if you want to call it. It's kind of like up fivefold. It's been amazing. Obviously, it's kind of key for a lot of defense applications. We have, like, some of the companies that we have in the portfolio have small amounts of tungsten, but it's a very, very small amount, component of the market. To be honest, when I've looked at some of the companies that have a reasonable exposure to tungsten, the valuation of these companies is pretty high. And what we've seen in the past with some of these commodities, it may be different this time, is that it's quite hard to price in the duration of current prices. And so, for us, I think we don't have a huge amount of exposure to that. It's just through some of the byproducts from our existing producers.
Brilliant. Thanks very much, Olivia, for your answers to all those questions and for your presentation. Obviously, a really exciting part of the market at the moment. So great to hear your thoughts. And thank you to the audience for your interest. We should have the presentation available online and a replay of the presentation for you to look at your leisure shortly. So hopefully we'll see you at the next one, which is, I think, Schroeder Japan on Wednesday. But that's all from us for now. Thanks very much, Olivia, and have a good afternoon.
Thank you so much. Bye-bye. Thanks, everyone.